When it comes to property investing, one of the most crucial decisions you'll face is whether to dive into residential or commercial real estate. Each sector has its own unique advantages and challenges, and understanding these differences can set you up for long-term success. Let's start with the purpose and types of properties. Residential real estate is all about homes. Think single-family houses, townhomes, condos, and small multifamily buildings with up to 4 units. These are spaces where people live, and they come with a certain emotional connection. On the flip side, commercial real estate, or CRE, is focused on properties used for business. This includes office buildings, retail centers, warehouses, and hotels, as well as multifamily properties with 5 or more units. The purpose of these properties is to generate income, and that's where the real differences begin to show. Now, let's talk about income potential and return on investment. Generally speaking, commercial properties tend to offer higher returns than residential ones. Why? Well, commercial leases are usually longer, often ranging from 3 to 10 years or even more, and they typically command higher rental rates per square foot. However, with that higher potential comes increased risks. Vacancies can be more pronounced in commercial spaces, and the upfront capital requirements are often steeper. Residential properties, while they may yield lower returns, usually have more stable occupancy rates and are easier to finance, making them a more approachable option for first-time investors. Speaking of leases, the structure is another key difference. Residential leases are typically short-term, with 12 months being the norm. This means more frequent turnover and the associated costs of finding new tenants. In contrast, commercial leases provide a more predictable cash flow, with built-in rent escalations and options like triple net leases, where tenants cover many expenses. Commercial property owners can enjoy a more stable income stream. Financing is another area where these two sectors diverge significantly. For residential real estate, lenders focus on the borrower's income, credit score, and debt-to-income ratio. Programs like FHA and VA loans are common. In contrast, commercial real estate financing is largely based on the property's income and performance. Lenders will look at metrics like the debt service coverage ratio and rent rolls, rather than your personal financial history. Often, loans are made to LLCs or corporations, which can be a game changer for many investors. When it comes to management, the intensity can vary widely. Managing a commercial property often requires more oversight and professional property management, especially if you're dealing with larger buildings or multiple tenants. However, the triple net lease structure can alleviate some of that burden, as tenants take on many of the operational costs. Residential properties, while easier to manage on a day-to-day basis, can lead to more frequent tenant turnover and maintenance issues. In summary, understanding the core differences between residential and commercial real estate is essential for crafting effective investment strategies. Residential properties might be the way to go for those seeking ease of entry, but commercial real estate offers scalability, stability, and the potential for long-term wealth building. If you're considering expanding your investment portfolio or making the leap from residential to commercial, having a knowledgeable advisor by your side can make all the difference. So, take the plunge, do your research, and let's navigate this exciting journey together.